started. Good evening and welcome again to another webinar with Sense Financial. Today we have a special guest, and the topic of today's presentation is mortgages, trust deeds, notes, and private lending. And I will be your host tonight. My name is Dimitri. I'm the founder and president of Sense Financial Services. And just before we dive into the topic, I wanted to quickly give you an overview about what we do here at Sense Financial. And we are a boutique financial firm specializing in self-directed retirement accounts with checkbook control. We've been servicing clients since 2010. Our clients love us for a certain reason, because we make effort to do that. We have hundreds of 5-star reviews on Google, Better Business Bureau, Yelp, LinkedIn, and Bigger Pockets. Over the years, we assisted over 3,000 clients, established over 4,000 self-directed retirement plans, and most of our business comes through referrals. We don't do marketing and advertising. Our mission as a company is to help our clients obtain control and protect their retirement accounts. Proverbs 21:5 says that good planning and hard work leads to prosperity. And we know that you work hard for your money, and we want to make sure that your money is working hard for you. And tonight is actually an effort to help you with that. Patrick is our presenter, which I'm going to introduce in just a couple of minutes here. Been a good friend of mine, a colleague, and a client, and I'm also a client of his. And I think you guys enjoy his presentation. But a little bit about self-directed IRAs and self-directed solo 401k. The benefits of these products is that they allow you to invest in alternative assets, which means that you can achieve true diversification. If you're just investing in the stock market, you don't have that diversification. Investment returns are tax deferred if you use traditional pre-tax account, or even tax-free if you use Roth account. What can be better than tax-free investing, right? You also able to leverage your funds using a non-recourse loan if you decide to purchase investment property. We set you up with the ability to have checkbook control over your IRA. So we place you in the driver's seat. And for those who qualify for a solo 401k, it is a great tax shelter. With the current contribution limit for this year, allowing you to contribute up to $73,000 per year. That's a huge amount of money that you can shelter from taxes. So this amount can be tax deductible if you're self-employed or business owner. You can do a lot of things. You can invest in many alternative assets, but there are certain limitations with self-directed IRA and 401k. And the Internal Revenue Code section 4975 on prohibited transaction rules defines those restricted investments, such as collectibles and life insurance contracts. And in addition to that, your plan, your IRA or 401k cannot engage in any transaction with disqualified person. What does the true diversification means? The credit for this cartoon goes to my daughter, but I think it illustrates the point perfectly. Man holds the basket, which represents the stock market, and the bottom fell off. All the eggs are broken. And the wife says, well, I thought that our investments were diversified. Well, guess what? If you are just in one asset class, in one basket, then you don't have that true diversification. Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth. And you cannot truly accomplish that with a self-directed retirement account. A true diversification means unlimited investment options. You can invest in residential real estate, commercial real estate, tax liens and tax deeds, precious metals, cryptocurrency. And you can use your IRA or 401k as a bank. You can actually become the lender. You can become a bank. Patrick will talk about this. And with this, I'm going to go ahead and bring Patrick up. And Patrick has been, let me go ahead, make sure that he's able to share his screen. Patrick is a real estate professional who began his career at Marsh Reddick more than 20 years ago. He has extensive experience in underwriting, analysis, and management of private credit investments with more than 3,000 loans funded and default rate under 2%. Pretty impressive. Today, as the Director of Private Lending, his focus is twofold. First is oversight of his actively managed, fully staffed private lending team housed in Newport Beach. And second is a capital partner relations, business development, and the sustainable organic growth of the Marsh Reddick loan portfolio. I known Patrick for almost 20 years. We used to work together, and Patrick is a good friend. As I said, he's a client of Sense Financial, and I'm a client of Marsh Reddick as well. I invested in probably several dozen loans, notes with him, as well as a mortgage fund. So with that, Patrick, go ahead and take it away.
Thank you, Dimitri. Really appreciate the opportunity to be here. And thanks to the crowd, the audience who's joined us and taken time out of their evening. Always a pleasure. And thanks for the warm introduction. That was well said. There's a lot to unpack tonight, folks, and we will never be able to get through all of it. So this is going to be a little bit of a high-level overview. And if there's one thing to take away from the presentation tonight, it's that you need to give private lending a try. I've been doing it a long time, and I've invested in a lot of different asset classes. And I find that it's the best mix of safety, which is extremely important. You always must protect the principal, but you also need to invest for a high yield. And so I find that private lending, especially when it comes to passive investments, it really does offer the best mix of safety and yield. So I hope to get your attention enough so that you'll give us and Marshall Reddick a try for the benefit of your self-directed retirement account. I do like crowd participation as well, and it's always good to get everybody moving. So we've built in a few polls in tonight's presentation. I think maybe we'll get started with one. Dimitri, are you able to launch the poll?
Yes, it is going, waiting for the results.
And so if you don't mind, would you reading that question for us?
Yeah, the question is, have you previously done any mortgage, trust deed, or not investing?
That's awesome. And just really good to understand who's out there and the crowd. You know, is this something that's brand new to people? Do they even understand what we're talking about with private lending? And just to kind of understand, the sentiment from the audience.
So we got a little bit mixed results here. Let me go ahead and publish them so everyone can see them. But we have 20% that have done it on occasion. 26% do it regularly. 13% no, because they think it's risky. And 40% said that they just learning and they want to know what private lending is. So majority of our audience is new to this.
Oh, that's awesome. Thanks so much for the participation. And I hope to address everyone, no matter what you voted for there, especially for those folks who seem to think it's risky. As from my perspective, especially amidst a sort of a volatile economic market that we've experienced of late, and the rising interest rates, and some people on the fence about what real estate's going to do, commercial, residential, and so on. I really do believe that a first lien position private loan at a favorable loan to value is one of the safest possible investments that you could be in, as you definitely have underlying collateral, which you can't say for a lot of investments, including equity investments in the stock market. So thanks for your participation. Just a little bit of an agenda as we move forward. We'll talk a minute about Marshall Reddick. That's the firm I work for. We'll have various interjections and answers on some education in terms of private lending, in some cases from the borrower's perspective. But again, tonight we're more talking about how you can utilize your capital, including your self-directed retirement account, to become the bank and invest in trust deeds, mortgages, and promissory notes. We'll have a few more poll questions throughout, so I look forward to hearing from you guys again. We'll talk about the private financing operation that we run here at Marshall Reddick, including our online mortgage marketplace. And we'll also give you some just little tidbits on how to get involved, right? As well as our track record. Really important to understand that we're not a huge operation, and that's by design, but this by no means is our first rodeo as well. We've been doing this for the better part of a decade, with many thousands of loans and many, many happy customers. We'll also have some time at the end, I hope, for some dialogue on interest rates and where they're headed, as well as some questions from the crowd. First off, understand from Marshall Reddick perspective, the map here indicates our office footprint. So I work out of our Orange County, Newport Beach office, but the other places here, this is where Marshall Reddick has our own brick and mortar offices with our own W-2 and independent contractor staff, which would be real estate agents, property managers, and so on. This certainly does not represent our lending platform. We lend in other markets outside of these, but you will find that we have a stronghold and a big lending presence where our own offices are, where we have a lot of quality control and our own staff to call on in the event we need to. We do, however, only lend in markets that are favorable for the most part in terms of dealing with the lender, right? Potentially staying out of judicial foreclosure states, and in locations that we don't have a footprint, meaning we don't have relationships with real estate brokers and property managers and lawyers and all of those people that you need to have in your back pocket to run a successful private lending operation. Overall, from a high level, Marshall Reddick offers 3 different services: real estate brokerage, so helping people buy and sell homes; property management, of course. A lot of the home sales that we do are investment. And so, of course, those folks who are buying and owning rentals, they need property management. And then, of course, our private financing arm, which is the arm of the business that I lead here from our Newport office. And this session focus, as I mentioned, is going to be really revolving around you as the lender and how you can make money lending money via our private financing program. And some of those buzzwords out there we've talked about: mortgages, trust deeds, note investing. Those are all words for private lending and what we offer here at Marshall Reddick in our private financing division. So important to understand and kind of define, maybe this is for that 40% that is just here and just learning, but private money is not new. It's a commonly used term in banking, and really it's about the lending money to another by a private individual or organization. So not centralized banking necessarily, as banks, of course, have traditionally been the sources of financing, where private money has non-traditional qualifying guidelines, and thus there's traditionally less red tape. And what's missing from this definition that I have there at the bottom as it pertains to Marshall Reddick is that we only do secured private lending. And the security that we will accept in exchange for our private loans is residential real estate only. So multifamily property is okay, but when it comes to commercial in terms of office, medical, industrial, and so on, we don't make those loans. So again, multifamily is okay, but we really do prefer single family homes. We're going to jump into another poll question. Dimitri, if you'd help me again, please.
Sure, let me get that going. Waiting for the results.
And if you don't mind asking the question, I'd love to hear it.
Yes, the question is, what is the #1 reason for borrowers to use a private money loan? So we have folks participating. I just want to inject also and tell people that if you guys have any questions for Patrick, you can go to the Q&A session there and type your question there. We will have some Q&A at the end, so you can you'll have the opportunity to answer your questions.
Yeah, look forward to it. No, there's no stupid questions, so let's get them out on the table tonight.
Right, so the results, let me go ahead and publish them for everyone to see, and I'll just read them. So 15% poor credit, another 15% cash down, 5% income, and then 65% speed.
Okay, so we have some really, really well-educated investors. I love to hear that. Most commonly, the misconception is that private money is for Alt-A borrowers or subprime. And so you'd think in that case that those folks are borrowing because they have poor credit, or they don't have the income, or they don't have the down. And that's 100% not the case. Especially in our program, the number one reason that folks are looking to private money is speed. And if you've gone to a bank or another financial institution and gone through a conventional loan process, you know just how absolutely painful that can be. And you almost feel like a criminal, right, in terms of how they're just sourcing everything in your financial space. That's because Fannie Mae requires a lot of that in terms of their guidelines. And so the conventional lenders have to abide by that. We certainly don't. We come up with our own guidelines, and they're very good, solid guidelines. And I often think about the way we underwrite loans as safer than those that conventional lenders are offering. Because at the end of the day, the conventional lender simply has to meet those guidelines of Fannie Mae. And as long as they do that, they go ahead and make the loan, right? Without regard to whether the borrower actually can repay the loan. From my perspective in our underwriting, it's important to understand that you as the lender are going to be holding this paper, and you're going to be collecting the interest payments, or our fund is. And so in that case, we need to be underwriting this that we are so confident that we're going to be collecting all of the interest payments until the maturity date. Right. So again, I think that that's a more powerful way to look at it, and the borrower's ability to repay that loan, and our confidence in the underlying collateral asset that is securing that loan. So thanks again for the participation. So when it comes to our private financing operation, basically we have positioned ourselves to where we're able to provide a very needed, common sense service to the borrower. Right, the borrower needs that private money for one of their business ventures, all revolving around residential real estate. And on the other end, and the back end of that, is that our operation provides a safe and high yield investment to the lender, who's going to actually bring in the capital and who's going to play the bank in this scenario. So then Marshall Reddick's role is to arrange the transaction between and amongst the parties. And not only are the parties the borrower and the lender, but they're also escrow and the title insurance company and the homeowner's insurance and the loan servicer and all of the real estate agents, potentially the 1031 exchange accommodator. So there are many parties involved in a lot of these transactions, and we're very hands-on in our program to facilitate and arrange the loan transaction between all of the participating parties. Diving a little bit more about our operation, it's very, very important to understand we have strict guidelines on the types of loans we will make, including the fact that we are strictly a non-owner occupied lender. So no primary residence loans here. These are all business purpose loans. First lien, very important as well. Worst case scenario as a first lien holder is that you end up owning the collateral property. That happens very, very seldomly, at least in our program, due to good collateral assets and good loan to values. But if you're going to do private lending, right, and you're going to go outside of Marshall Reddick, do yourself a favor and don't lend in any position outside of First. That's the safest and only place to be, in my opinion. When it comes to lending of any type, loan to value is one of the most primary metrics, if not the most primary. The lower the loan to value, the lower the risk. The higher the loan to value, the higher the risk. So I sleep well at night knowing that our guidelines support favorable or good or solid loan to values. As far as the underlying collateral asset, the question you have to ask yourself when deciding if you're going to make a private loan is, are you willing to own that collateral asset or that subject property? So we take a lot of the guesswork out of it with our in-house underwriting team. And that goes for not only the asset, but for the first lien position, as well as the good loan to value. So when it comes to private lending at Marshall Reddick, as you're going to see, and we move through this discussion, that we ask these questions before we even show you the transaction. So if it's not first lien, or it's not a good or favorable loan to value, or it's not an asset that we would be willing to own for the loan amount, it wouldn't even make it to your inbox or to our marketplace. Some other important aspects here about the operation. We're not lending to the weekend warrior or the first-time home flipper, right? We have a very loyal, recurring, experienced, and professional borrower base. And this is really important, right? We're supporting local, around the country, small real estate brokerages, small property managers, small we buy houses for cash type operations. And these folks are borrowing from us on a regular basis. In some case, maybe 2 or 3 or 5 loans per year. And in other cases, it's 25, 30, or 50 loans per year. And some of the relationships with these people go back a decade or more, and hundreds of loans, right? And that type of, underlying metric to the loan really goes a long way. And it's one of the main reasons that our default rate is so hyper low. I also think that our internal and conservative and skilled underwriting is extremely important to our operation and to how I run this operation. Being exposed to real estate early on in my career in the early 2000s and seeing what the real estate market did as the lead up to 2008, and then going through the whole 8, 9, and 10, and that destruction that happened, that really shaped my mind and the way I approach this program and as a money manager. And so, we all work too hard to save. And so principal preservation is always paramount when it comes to investing money. And so you're going to find that that is the case with us in our private financing operation. Just very conservative, very skilled underwriting. We are going to make sure that we're going to get those dollars back, and we're going to have a great experience doing it. We currently manage about $100 million. So again, we're not a huge operation, but certainly this is not our first rodeo. We're originating someplace between 30 and 50 loans per month. That's an average. And we currently have roughly 589 loans in our pipeline. So 589 loans out that each have an individual lender and each have an individual borrower. Some lenders have more than one loan about that 589, and certainly some borrowers have more than one of the 589, but it's just important to kind of understand, what does this program look like that we're managing on a day-to-day basis? A little bit further, understand who are our borrowers and who are our lenders. So we touched a little bit on the borrowers, that these are all real estate professionals. Probably our biggest clientele is the we buy houses for cash operations. And you see some of those commercials on TV now. You see those signs around town that say, off-market flip and so on. So that's probably our largest. But we also are working with a lot of small home builders, spec home builders, custom home builders that are building infill new construction. So we do a lot of ground up new construction loans. And we also have a niche for non-recourse loans. And that's obviously very important. And a lot of folks listening in have self-directed retirement accounts. So they understand that if you're going to use that retirement account to purchase and own real estate, and you're going to do it with a loan, you need a special loan called a non-recourse loan. So we fill that niche for a lot of our clients that are utilizing our brokerage and our private property management operation. And so we do some of these longer term rental or hold type loans. As far as our lenders and where the capital comes from to fund this program and to fund each individual loan that's being originated, these are just private capital partners. These are Dimitri, as he mentioned. This is me, Patrick. I lend a ton of money on my program. A lot of Marshall Reddick capital partners, a lot of Sense Financial capital partners. These are just individuals who are choosing the route they want to go at Marshall Reddick, which there could be the direct lending where you actually own the trust deed yourself, or perhaps you prefer the safety of the mortgage pool as opposed to the direct ownership. It's very important. I have here is a lot of my lenders or my passive investors are utilizing their self-directed retirement accounts. I personally, as Dimitri mentioned, I'm a client and I have been a very long time. I have 2 self-directed retirement accounts, a self-directed IRA LLC, and I also have a solo 401k. So I use both of my retirement accounts to make private loans on my platform. You can do the same. As I mentioned, you have 2 options to invest when it comes to our private financing operation. Number 1, that's direct lending, right? And about half of the capital that we manage is in this program. This is one lender on one loan. There's no fractionalization. There's no crowdfunding. This is the more active of the 2 options, right? You basically decide and you pick the already approved, fully underwritten transaction, right? Marshall Reddick's underwritten. We've said this is a good loan. You get to look through that available inventory of those Marshall Reddick approved loans, and you get to pick and you get to fund that loan as the bank. It's your name or your self-directed retirement account name on the paperwork. So chalk this up to the more active. If you want to equate it to the stock market, this would be like owning Amazon stock directly. Whereas the other option is a little bit more diversified, a little bit more passive option. About half of the 100 million that we're managing is currently housed in this operation, right? This is the more passive option. This is where you're relinquishing the control of the choice and you're investing with the pool with hundreds of other capital partners and millions of dollars of capital. So then you relinquish the control of the choosing to us as fund management. So we pick and fund. And this is more, again, going to the stock market and the equity market. This would be more like owning a Vanguard mutual fund as opposed to owning the Amazon stock directly. How about the role of Marshall Reddick? Well, the role is fourfold here. Obviously, we have the shop. We have the operation. It's our role to attract the clients and to build the relationships. Relationships in real estate are terribly important. So we are constantly attracting the borrowers. We're building the relationship. In the deal flow. Certainly a lot of borrowers would love to find the lender directly and the lenders would love to find the borrowers directly, but a lot of the clients are very busy, right? This isn't their full-time job. So Marshall Reddick offers that service or that role. We also are the processor. We're the underwriter, right? We take a loan application from every one of our borrowers. We interview every one of our lenders to make sure that they understand the situation and what's going on. We set our own guidelines, the types of loans we will make, the loan to values, the interest rates. We structure the loans. We structure them obviously in the safest way possible for the lender while still getting the borrower to say yes to the transaction. And obviously we're issuing the approvals. As a direct lender, you get to choose whether you want to do that loan or not, but we are still the ones processing and underwriting and touching all the different parts of the loan. We're the loan broker, right? We talked about the fact that we arrange the transaction. So we deal with escrow, title, insurance, and the loan documentation. It's important to understand here too that we do all of the things that a bank would do, right? All of those safeguards. So when you lend money on Marshall Reddick's platform, right, you're always going to be using a third-party escrow. Marshall Reddick will never touch your money, right? There'll always be title insurance. right, to ensure that your lien is in first position and that there are no clouds on title from the prior ownership or prior lenders. We maintain homeowners assurance to ensure the underlying collateral property in the event of fire or other hazard. And of course, the loan documents, the promissory note, the security instrument, which is the deed of trust or the mortgage, and all of those other documents there for the protection of both the borrower and the lender. And then ultimately, we don't just let you fund the loan and then forget about you. It's a very hands-on, very actively managed program where we're making sure that the payments are being made timely. We're involved in the loan payoff when that time comes and the property, the collateral property that's being flipped or that's being improved is being sold to ensure that you get your money back, right? And then ultimately, the last part of any secured private loan is to release the lien that was previously perfected by the deed of trust or the mortgage. So kind of just again, touching on the four main pillars of Marshall Riddick's role in our private lending program between the borrowers, the lenders, and all of the associated parties involved. Let's talk a little bit about the types of loans we originate. There are four main types as well. Again, number one being renovate loans. These would be existing properties that are being improved. These are hyper short terms, right? 6 to 12 months. That's the maximum term, right? The borrower could certainly pay off the loan in advance of that. And the borrower actually desires to pay off the loan as fast as possible because the interest rates are high, right? So the shorter they hold the loan, the less interest that they owe. Whereas from our perspective as the lender, right, we want the loan to go all the way to term, right? Because we want to keep our funds invested and earning as much as possible. Because the longer the loan's out, the more interest we're going to make. So I won't go through each one of these in terms of the term and the LTVs, but just understand again that these are favorable loan to values. These are based on current or appraised value and also at favorable yields. And we think, though, that these yields, right, these this income to the lender is in line with the associated risk, right? Because there are many investments out there that could potentially yield higher than this, right? But are you taking on and can you quantify the associated risk? And is that risk worth the yield that you're going to be gaining? Right. And so a lot of folks invest in equity syndications, real estate syndications. I won't spend too much time there, but just know that in that case, you're the equity, which is behind the debt. And in essence, you're in second or junior position. The yield better be significantly higher, potentially double to these, because again, you're taking on much higher risk than you would as a first lien holder, the debt side of the business. So again, renovate, that's our biggest, probably 65% or so of our capital is going into those loans. Bridge loans, these are no improvements, right, to the subject property. These are short to midterm. We talked a little bit about the new construction that we do, as well as the longer term that we do. Again, you as the lender, if you want to be a direct lender, you get to pick which program you want to be in based on the underlying deal. And of course, if you prefer to get into the mortgage fund, we as fund management are deciding on the allocation. That current allocation is 75% 12-month loan term or less, and 25% 12-month loan term or longer. So we are very pro short-term debt that allows us to constantly revisit the interest rates based in a volatile interest rate market, that allows us to constantly adjust our loan to values in a changing market and to really reprice and reassess things. So that's our preference as much opposed to longer term debt where once the debt is set, there's no options to change it except for selling the debt, which is certainly something you don't want to be in the position to have to do. Little education here for you. Private money pros and cons. These would be from the borrower's perspective as opposed to the lender. So speed, we talked about that. Allows the borrower to scoop up bargain properties. There's also the underlying guidelines, right? Not like Fannie Mae. The deal is important to us. The equity, the down payment is important to us, much more important than income and employment, right? Not that income and employment are not important, but if someone's putting 50% down on a $500,000 property and I'm lending the other 50%, I feel fabulous about my position, regardless of how much money the borrower earns or whether they're employed or not. Some cons, well, the fees and rates, they're higher, right? And the private market sets the standard here for the fees and the rates charged to the borrower, right? Not the government or Fannie Mae. Another con would be the loan terms. Generally shorter durations, prepayment penalties are very common for the benefit of the lender. And then, of course, balloon payments. Balloon payments, simply a large payment at the end of the term to pay off the unpaid principal balance. Also important to kind of understand primary versus secondary. So we mostly do private lending here, which is a primary market transaction or an origination of a new loan versus buying of notes, which is very common in the non-performing loan space, right? Or a secondary market transaction. So when it comes to private lending, again, we're funding a brand new loan for the borrower. The loan amount is not negotiable, at least with us, right? We've already done the underwriting. We've already structured the transaction. We've already gotten the borrower's approval before it hits our marketplace and before you as the capital partner are able to see that. This is a primary market transaction. The loan terms are established and new loan docs are signed by the borrower. Opposite of that, of course, buying notes, you would purchase or take over an existing loan from the current lender. In this case, the price you're going to pay for that unpaid principal balance or for that loan is negotiable. And then this is, of course, a secondary market transaction, as I mentioned. And this is not uncommon, folks. Think about conventional lenders and banks. They're the they're the lending aspect or the origination of the primary market, and Fannie Mae buying that debt from those conventional lenders is the secondary market, right? Where there's no change to the existing loan terms and the current loan docs are assigned to the new lender who's coming in to buy that from the originator. So I hope that helps understand a little bit of difference about the two. We do support the buying of notes, right? So if you as an individual capital partner or a direct lender, right, and you need to sell your loan for some reason, you know, God forbid, a family emergency or medical emergency, we do support that. And we certainly have a much better option than the other note buyers that are out there that are going to want to buy at steep discounts. Okay. Very important, and one of my favorite things about our private lending program is our mortgage marketplace. This is a quick little screen clip of what the list view will look like, where you can just get a rundown on not only here what I'm showing available loans, right, fully underwritten, already structured, and just now looking for the capital, and a high-level overview in terms of what's the yield, what's the lien position, what's the length of the term, and what type of transaction is it, right? Originate a loan or primary versus buy a loan and secondary market transaction. And then important to understand that each loan has a listing page. This is an example of one of those listing pages. And we've gone to great lengths to publish all of the information that we think an individual capital partner needs to understand, needs to digest, that needs to know in terms of due diligence to decide on whether this is a good loan for you to fund or for you to bank or for you to own as an investment. Again, so each loan that is published on our mortgage marketplace has its own listing page. This is just an example. So this mortgage marketplace is like the multiple listing service, right? An MLS, which many of us are probably familiar with, but in terms of property, right? That's where listing agents go to list their clients' properties that are being sold, and where buyer's agent go to help their clients find and source those. This is for loans, however, right? So we have borrowers that need capital, and we have the lenders who are looking to place capital. This is online. It's public access. It's not a paid subscription. In all reality, you don't even need a username and password to the Marshall Reddick website to access it. To become a lender, however, you will need a Marshall Reddick username and password. Just like the MLS for properties that we're all used to, this contains all of the historical data on all of the loans. So our entire operating history, in essence, is transparently housed online for everyone to see in real time. This is a live and constantly being updated website, right? My team is constantly updating it. And I've got over here to the right a little screen clip about the loan statuses, right? So available, of course, would be those that are available for investment now, and they just move in chronological order as they move through the flow. So pending means we already have a loan commitment. Active means they're funded and they're in play, and so on and so forth. So again, this marketplace is being updated 24/7. This is where you go to find our deal flow and to shop for investments. So after doing this for many, many years, we have hundreds, maybe thousands of people looking at this marketplace every single day. So it is competitive. It is fast moving, but there's plenty of deals to go around. There's plenty to review, and you can learn on the fly by seeing what other investors, just like yourself, what types of loans are they funding. All right, Dimitri, if you're still there, let's get the crowd back involved with the third poll question.
Okay, the poll question is, what is the most important when considering a mortgage, trust deed, or not investing? Waiting for the results.
Also very good. I love this question. What is most important? We touched on this, so if you were paying attention, you'll know my answer. Want to publish those results, Dimitri?
Okay, still changing. Okay, let me go ahead and publish. So we have 10% investment yield, 5% borrower's credit, 75% loan to value, and 10% subject property location.
And so we do have everyone paying attention. I love that. And indeed, loan to value is the most important when it comes to private lending. Don't get blinded by yield. That happens a lot. And of course, the most competitive loans on my marketplace are always those that are yielding 12 or 13%. For some reason, everybody wants those deals. And obviously, I understand that. And that makes sense. And I don't think that any loans that we publish are risky per se. They all, again, that first lien position, they're all fully underwritten. They all meet our internal guidelines. But nonetheless, the higher risk, the higher reward. So those higher yielding are going to be the higher loan to value loans. But the others are just not as important. Subject property location is a close second. But really, when it comes to borrower FICO and so on, those are important, but much less important than loan to value. So thanks for the participation. All right, let's talk a little bit about how to get involved with Marshall Reddick. One of the most important things here is going to be build a relationship. You really want to get to know who you're working with. You want to get involved. You want to get on a first name basis, on an email basis. And as I mentioned earlier, you need to give us a try, right? I'm very confident that you're going to be satisfied with the level of customer service that we provide, the level of safety that we provide. And, it's all about being friends. And so we desire to build a relationship with you, and we encourage you to desire to build a relationship with us. So first step, visit our website, create an account, explore, right? Remember that marketplace is public and open. You need to learn how to navigate our mortgage marketplace. There's a lot of data there, and it can be confusing at times. It's actually very simple. And once you get involved, and once you learn how to use it, you're going to be able to easily see our deal flow and track what we're doing. You also need to learn about Marshall Reddick Mortgage Fund, right? This is a little bit different animal, and we don't have time to speak about it this evening, but it is an option if you prefer the safety of a mortgage pool right? As where you own a fraction of hundreds of loans alongside other lenders and millions of capital, or do you want to go it alone on your own as a direct lender and own an individual transaction or a handful of individual transactions on your own? You want to read reviews. You want to schedule a consultation. And as I mentioned, number one, build a relationship with myself and my underlying team here in Orange County. So that QR code that's on the screen there, that will direct you right to where you can schedule a consultation online. We'd love to speak with you in that regard and answer any questions, help you learn how to navigate the marketplace, and help you learn more about the mortgage fund and everything that we do. You also then need to decide between direct lending and the mortgage fund or both. A lot of our capital partners do both. They like to get involved initially, perhaps doing a couple of loans directly and kind of learning the ropes. And then I find a lot of folks prefer the passivity of the mortgage fund, understanding that the yield is essentially the same, right? Some people can do better in the direct lending, but equate it more to day trading, options trading. It's a much more active way to invest as opposed to taking a more passive route where you're relinquishing the day-to-day and the management to the principals here of the mortgage fund. Of course, then, don't get analysis paralysis, execute and make an educated decision to make an investment. I'm quite sure you'll be glad you did. Right? And I encourage you to read some of those online reviews. I'd be happy to give you referrals to speak to folks that have been lending with me for the better part of a decade. And in all reality, you have the best, most trusted referral in Dimitri, who again is someone I've known for nearly 20 years, who's done many, many loans on my platform directly, who is an investor in my mortgage fund, utilizing both personal capital and his self-directed retirement account. So I do appreciate that, and speak up and ask people for their assistance and how they got started. Okay, let's briefly run through our track record as we sort of get to the end here. Again, not our first rodeo. So I updated these prior to jumping on this presentation. So 3,154 loans originated to date. That number going up every single day. 589 loans actively in the pipeline, which includes 567 originations and 22 secondary market loans that were originally originations, then purchased by a different lender. 2530 loans paid in full. So full interest, full principal, no hiccups, exactly how you'd like it to work. And of course, we do have some defaults. Right? Defaults are part of lending money, whether it's private, conventional, or otherwise. We have a total of 57 of those. So quick math formula there. Of our entire operating history, we're a little under 2% in terms of that default rate. And it's very, very important to understand that a default doesn't necessarily equal a loss of principal. And in many of those 57 loans, they worked out just fine. It might have gotten a little scary or a little hairy there for a minute for the underlying lender. We may have had to get a lawyer involved. We may have had to advance property taxes or force place insurance. But in, again, many of those cases, the lender got paid in full through the sale of the property. And I'm going to dive a little bit into those defaults because I always get a lot of questions about those. So again, I won't go over each of these scenarios. But I have listed at the bottom, and I've given you a URL. Hopefully, Dimitri will provide you with the slides or the recording, and you can visit this URL, which is on our website and gives you the definition of all of our loan statuses, including the 1, 2, 3, 4, 5 default loan statuses that you see on your screen now, so that you can fully understand what each of these are. Right. But again, as the first lien holder, the worst case scenario would be a scenario where it's a deed in lieu or an REO, which is a real estate owned or a failed foreclosure sale. In either case, right, you ended up with the subject property and the loan is over. In the other scenarios, the lender always got paid and the lender agreed to whatever the loan completion was. So again, always your choice. And again, that's the benefit of the first lien when it comes to private lending or any type of lending. All right, Dimitri, let's have you come back in. We've got this and one more poll question.
So poll question number four, what are the benefits of a mortgage trust deed or not investing? And the answer choices are safety, consistency, yield, Marsh-Redick track record, and all of the above. And
So a
still
little bit
have,
of trickery there. Certainly everybody has their own perspectives, but as everybody's answering, my answer to that is all of the above. As I mentioned, sort of getting started, the private lending really offers the safest place for the highest yield, and a monthly fixed interest payment at a good yield is just lovely, right? Especially if you've got a solid loan to value. And of course, if you throw in the Marshall-Redick track record that we just went over, I think that this is a special place for investors to be. It's certainly a place that I believe in and invest most of my liquid net worth into. It's just an important question that you folks want to be asking any service provider that you work with, right? So take your financial advisor who's asking you to get into this stock or this mutual fund. The question I would ask them is, are you invested in that? So I'm happy to say if any investor considering investing with us and me in our private lending program, I absolutely do. And I'd be happy to show you all of the different deals that I have personally done with my own personal capital. What were the results there, Dimitri?
Most people answered all of the above, 88%.
Very good. Thanks, folks, for the participation. Okay, sort of a wild economic time. Talked about that briefly. We've had, let's see, I think 18 or 20 months or so of rising interest rates. I think it started happening back in March of maybe 22. So we'll be coming up on a 2-year anniversary in March of 2024. So it's just really an interesting time. I think the Fed should have maybe gotten involved in raising interest rates much earlier on. I think that they were hesitant to do so post 2008 in the Great Recession and held them very, very low. I think they intended maybe to try and do that before the onset of the pandemic. And then, of course, they dropped again. And then now, of course, inflation out of control. They have no choice but to try and raise them, which creates its own unique problems. And I think we saw those problems with the rapid rise in the interest rates, with the failures of Silicon Valley Bank, Signature, some of those other banks that were out there. And I think the Fed's in a real conundrum in terms of, what they're able to do. And it's really unfortunate. So everybody knows who we've got on the screen here, Mr. Powell, and he's celebrity status today, if you will. But I think as we move towards our question and answers, I'd love to get the sentiment from the crowd with our last poll question. I'll certainly give you my thoughts on the situation, but Dimitri, if you want to get us launched here, and let's get everyone's sentiment on where interest rates are heading.
So poll question number 5, where is the government interest rate headed? Double digit, hold, no change, down, can't wait to see 3.5%. Me too. Not a clue.
Yeah.
And,
most people probably don't have a clue. I would say, I thought about this a lot. I'm 42 years old. I was born in 1981, and I always hear the stories about my mother and father talking about when they bought their first home and your rates were 20%. And I always thought, that's hogwash. We're never going to see that. And the rates that we're at today are not uncommon, right? When I bought my first rental property, conventional loan in 2004, I had a plus 7% 30-year fixed. But we've all been spoiled, and there's this whole generation of folks that have come up that know nothing more than 2, 3, 4%. So, I thought for the first time in my life, I felt that double-digit conventional or federal government rates are possible. I hope that's not the case, but I do think that that's possible. And yeah, Dimitri, what do you think?
I think we'll see some increase, slight increase over the next few months. And then hopefully they'll drop. But this is based on what I've been listening to experts to say. I don't really have my own opinion on this.
Yeah, I hear you. And I also think that coming into a unique election year, I think probably I share your sentiment that maybe they're going to go down towards the early or mid part of next year. And then I think it really is going to depend on the administration that's going to be taking us forward as a country in early 2025 and beyond, to see kind of what that monetary policy is going to look like. But what does the crowd have to say?
Well, we have 16% double digit, 61% majority hold, no change, and 22% have no clue.
We didn't have anybody voting for, I hope to see 3.5% again, huh?
Yeah, that's probably not happening ever in our lifetime. But I was lucky enough to secure a sub 3% interest on my primary, which is, I don't think I'm going to ever see that again.
Yeah, no, I feel lucky too. And I bet most of the folks on the call were lucky enough to do that as well. I think that has perpetuated our huge inventory problem. And one of the main reasons that residential real estate is holding its value so tremendously well is because there's just no real need to sell, right? And only those folks that are moving for job wise, or, some for military or some other, underlying reason, or, death in the family and the kids inheriting the properties. And that helps me in my business, because that's a lot of folks, and a lot of my we buy houses for cash type folks. They're right there following those probate records, following those different scenarios. And I think the flippers are out there. The ones are the only people moving residential real estate inventory today. So it'll be very interesting to see. But regardless of the rising interest rates, regardless of the overall market sentiment, I still firmly believe that first trust deed at a favorable loan to value is the best place for safety and yield. And I hope that everybody got a taste of what Marshall Reddick offers. And with that said, if we've got a few minutes, I'm more than happy to field any questions.
Yeah, we actually have quite few, so let's see how many we can get. So first, from Ross, what about SEC regulations?
Sure. Good question. When it comes to the SEC, we are registered. Our fund is registered with the SEC. So you can go to the Edgar online platform and you can check that out there. So there's a registration requirement. We are a 506C private placement. That's a fancy word, but it is one of those carve-outs or exemptions that came out of, Dodd-Frank and that whole situation. So there is some element of government oversight there, but certainly our fund is not publicly traded in that capacity. It doesn't have audited financials. But when it comes to the direct private lending, no, there's no SEC oversight, right? You're making the choice. Just like, if you want to go online and buy any stock of your choice, you're welcome to do that. And you don't have to ask the government for the option to do that.
All right. Next question from Kai. Do you have a legal team and funds set aside to intervene in case of a borrower's default and the lender has to take possession of the property? You touched on this certainly, but anything to add?
Yeah, absolutely. It's a great question, right? Again, there's two variations. There's direct lending and there's the mortgage fund. So 100%, internally, Marshall Reddick, we have a legal team, and we have, that legal teams around the country. They're state specific. Each state has their own unique laws. And of course, the mortgage fund has capital set aside and an allocation for defaults if they do occur. However, it's important to note that if you're going to be a direct lender, right there, you are the party who needs to have the capital set aside, and you're the party who's going to need to cover the attorney cost. Now, we allow you to leverage our resources and we consult with you in the event of default. I mean, chances are we're going to tell you that a loan's defaulting before you're going to know that it's going to default, right? Because we're connected with the borrower and we're monitoring the insurance and the property taxes. But at the end of the day, as a direct lender, you're choosing to fund that loan. So we're here to help 100% of the way and utilize our resources to do so, but at your expense and ultimately at your choice. It's your decision on how to move forward. We can just give you the tools and our recommendations on how we would handle.
Next question from James. I noticed on your website a loan for sale for $50,000 in Florida. I have a self-directed IRA LLC with Sense Financial. I only have about half the funds available in my self-directed IRA at this time to fund the loan. Can I use another cash account alongside with my self-directed IRA LLC to fund this loan?
Well, I'm going to have you answer some of that, Dimitri. But first, I'll point out that we do prefer it's one lender on one loan. Now, the unique situation that was being described there is partnering up self-directed retirement funds with other funds that are yours. So, you know, that we're going to look to Dimitri for conversation on disqualified transaction potentially. But on the surface level, I don't have a problem. Let's say if it was an individual person and that individual person's LLC, right? Those two parties are owned and managed by the same individual, and therefore we would allow fractionalization on that particular loan in that type of scenario. But I'll let Dimitri speak to the advisability of the question.
Yeah, it's we're now getting a little bit into gray area because you are now partnering with a disqualified person, and you know if everything goes well, then that's fine. But if there is a default, then that potentially can lead into a prohibited transaction. So it's not the best scenario. You can partner with a non-disqualified person, but I don't believe Patrick, you will accommodate that, but yeah, something that I guess discuss.
Yeah, when it comes to partnering up people that don't know each other on an individual loan, right? Again, if the loan goes fine, that's fine. But if it's in a default, and let's say we had 2 or 3 lenders that don't know each other that are partnered up that all have to agree on the path forward, it gets messy. So we prefer not to do that. And so, you know, our overwhelming majority of our loans are again one lender on one loan. The alternative there, you know, is the mortgage fund, right? Which does have a low minimum threshold of investment at $25,000. So if you've got half of that amount and you can qualify for an investment there, that would be your best bet if you're uncomfortable partnering up with personal funds.
All right, next from Jamie asking, when you calculate LTV, is it based on purchase value or ARV?
That depends on the situation, and we publish both metrics. If it is a renovate loan that does have upside or will be improved, then we're going to show you various different metrics, including loan to purchase price, loan to current market value or appraised value, and loan to after renovation value. Each mortgage listing that we have has those associated LTVs. If you revert back to the slide I showed earlier, that had loan to current market or appraised value, not loan to after renovation value. The maximum we'll go on loan to after renovation value is 70%.
All right, next question from Jamie. Also, in case of a default, how does any of the lenders has any of the lenders kept the property and rented it out?
Oh, absolutely. When I showed that list of 57 defaults and those 20 deed in lieu transactions, which is actually the majority, you never want to go into this from a predatory lending perspective, although some people like to do that. At the end of the day, if there is a default and you prefer to simply take the property, we get the borrower's agreement to do that, or there's a foreclosure situation. Yes, I think that the majority of those 20 kept the property and, you know, turned a lemon into an orange, or whatever that scenario is. By all means, that's your perspective. I've also seen people take those properties, finish the improvements or the renovations, and list them on the market and sell them at a premium. So again, by no means does a default equal a loss of principal. It just means we've got to take action to protect your interest in the subject property.
All right, next question from Agata, who says, does one need to be a accredited investor to invest with you?
That's a great question. Yes, 100% on the mortgage fund side with the SEC oversight. We as a 506c can only take investments from accredited investors, which are high income earners or relatively high net worth. On the direct lending side, it's not as regulated, and it's more of an interview process to understand, hey, can you quantify what's going on here? Do you understand the associated risks? Can you bear the potential risk of loss? And so we're very hands-on in that regard to interview that capital partner to determine their aptitude before we'll accept their commitment. We certainly don't just take anybody's money off the street that's willing to lend us their last and only 50,000. That's just unacceptable from a fiduciary and ethical standpoint, in my perspective.
All right, next question from Raphael. Do you guys have a wholesale division that partners with mortgage brokers?
We, for the most part, do not. Periodically, a mortgage broker will approach us and ask us, but we are lending our own equity for the most part. Right? We don't have a wholesale or some kind of line of credit that is funding these. We're using money from direct lenders like yourself or our mortgage fund, right? So that has allowed us to stay small, which has allowed us to keep a really good handle on our overall program. And again, keep that default extremely low and to have relationships with all of our borrowers and all of our capital partners, which is how we'd like to keep it.
You and I think last one from Gary. How do you choose which loan your mortgage fund gets instead of to a lender?
That's also a fabulous question, and I'm happy to answer that one too. So the bottom line is that using direct lender capital is much more of an active business for us as well. And the mortgage fund is much easier transaction. Okay, so when the mortgage fund has capital, it will take priority. Okay, so for example, in this third quarter that we just ended, I had an overwhelmingly large amount of payoffs to the mortgage fund. And so there was a period of time where the mortgage fund was literally taking all loans that were coming through our pipeline, which restricted the flow to the direct lender. But a lot of times the mortgage fund is out of capital and is fully deployed, which is what is the goal and how we're able to keep that yield as high as we can. That's when the direct lenders fill in. But that doesn't mean by any means that the loans that are left for the direct lenders are poor or in any shape not as good, right? They still meet our guidelines. They've still gone through full underwriting. It's just a function of whether the mortgage fund is full or not. So I hope that helps answer that very unique, very, very good question. If I didn't get to it, go ahead, Dimitri.
Certainly makes sense.
Yeah. And again, there's a lot to talk about here and a lot to unpack. And I'm sure there are other questions that we didn't get to. I'm very appreciative of everyone's time. And I just would encourage you to reach out, right? Whether that's email, whether that's telephone, whether that's scheduling a call on our website using that QR code that was in the presentation. It's all about just getting involved. So I hope to speak with you guys. And again, Dimitri, thank you so much for the opportunity to be of service.
Yeah, thanks for joining us, Patrick. Great presentation. Thank you to all the attendees for joining us as well. I do encourage you to reach out to Patrick and just get the conversation going so that you can start learning about this. Again, I personally invested with Patrick in many loans as well as in his fund, and I certainly encourage you to do the same thing. If you guys have any questions about self-directed retirement accounts, happy to chat with you about that. You can schedule consultation on our website. I'm happy to just kind of brainstorm with you, get into your shoes and see what's best for you. but we are out of time for tonight. Thank you so much for joining, and we'll conclude here.
Bye-bye.